Hi, it's Thursday, June 16th. Today I'm going to talk about a few things that are going on in light of the current market conditions. So that's one of my bullet points here, the market conditions. Are we bear market? Well, yes, we are. Are we in a recession? Not yet, but we possibly could be. The second thing is the economic landscape and how that is really dictated by government policy. And third, investment opportunities that we're seeing as a result of these areas above, highlighted specifically by dividends and dividend-paying companies. There's a lot of opportunity, we think, in this environment, and I want to share with you how that looks here in a minute. So first of all, again, back to market conditions. We have the S&P down 24% as of today. We have the NASDAQ down over 30%. We have the 10-year, 30-year Treasury bonds both losing significant value from the start of the year. Those yields, as remember, the offset yields are way higher than when they started the year, which causes the price to drop. So there hasn't been a lot of places to hide. Even conservative, traditionally known as conservative investments in fixed income, have lost double-digit values during this year. The more speculative assets are even worse. So we've all seen some of those things. The small companies, in what we do here, small companies have had the worst showing so far in 2022. There's so much anxiety and uncertainty with how high the rates are going to be going with the Federal Reserve, and also just the outlook for how long inflation is going to last. We talked about the Fed being late to the party on getting rates up to a point where they could actually tamper down the economy a little bit. We talked about that even earlier this year, clear back in January, about the Fed being behind the curve. Yesterday, now they're trying to play catch up. They raised rates by 75 basis points, 0.75%. That hasn't happened since 1994. So you can see how they're trying to now rush this rate hike cycle through. That's sending a lot of shockwaves through the economy. Again, people are worried, they're nervous. We see inflation not stopping. 8.6% was the last number that we received on inflationary year-over-year numbers. That means the value of your dollar lost almost 9% year-over-year. So how are you going to keep up with that kind of an increase in the cost of goods? You certainly can't do it sitting in the bank. Well, most people would say, well, yeah, we're certainly not doing it having our money invested in the market and seeing the values drop by 20, 30, 40% even. So we're going to talk a little bit about the nature of the markets, why they're going down, when maybe they are going to stabilize, and how quickly they can recover. And I think that's a really big point that we want to make today is markets always recover. It's just a matter of you going to be there when it happens. When they do start that recovery, it usually happens violently and quickly. And unfortunately, a lot of folks miss that boat because they want to get out and wait for all the fog to settle and the coast to clear up and the horns to sound. And then by then, it's always too late because that boat sailed. The economic landscape we're talking about right now, remember, government policy, it really drives the economy in the near term. So we've had a lot of excess spending. You remember the $6 trillion that the government pushed through to help solve the pandemic, the spending, the largest amount of spending we've ever seen in this country. Did we have it on hand? No, we didn't. We printed that money. And then we also proposed, the current administration proposed another $2 trillion in spending for social spending and new energy infrastructure spending, $2 trillion in January, which was voted down by Congress. And that was as a result of just a couple of Democrat congressmen who decided to not vote yes on that spending. I think that's fortunate at this point and not political here at all. I'm just trying to say that too much spending has led to this inflationary environment. It wasn't Putin or the Russia war or whatever other area that this current government administration wants to point the finger at. It's really a result of the policy that's been put in place. Shut down the economy, put everybody at home, shut down factories, shut down plants, shut down stores, put people out of business almost, and then expect to just get right back up to where we were. And we all know that it's just not possible. So the economic landscape, government policy, hopefully we'll start seeing a shift in that. We'll start seeing people become so agitated and upset with current law that there will demand a change. And you're going to see, I think, a fairly significant change later this year as the elections play out. I'm just telling you that what we're going through right now, it's not sustainable. And people are very upset about what's happening. So we have to make a shift, and we can't keep pointing fingers and blaming everyone else like corporate greed or Putin or Russia or anyone else. These kind of things have happened for decades and centuries, even wars and other conflicts, and they've never led to this kind of an environment in our country before like this. Investment opportunities, let's talk a little bit about that. I'm excited about what's going on in the market, to be honest with you. We see this all time and time again as trying to invest money for clients at the right time, at the right price, hopefully putting money to work where it actually can make good return. You know, we've been, over the last couple of years, there's always been, well, we got to put the money to work, but the valuations are getting high. And Shaun's going to talk in a minute about how we've trimmed back in a lot of those areas because they were stretched, and we talked about that. But now we're seeing values that we haven't seen in many years. They've reset so quickly that we're seeing prices in a lot of these really good companies have dropped 20, 30, 40, even 50% from where they peaked out. Let me show you what I mean by the dividend yield and how that changes when prices decline. So I've listed 5 companies here, and I've also listed the annual dividend amount that they pay for every share of their company stock. So if I looked at Advance Auto Parts, for example, they pay $6 per share every single year. That's going to come quarterly. Every quarter they make a payment. Now the 52-week high on these companies, as you can see I've listed here. Jump over to this column and notice the price difference between the high and the current price, which most of these are at the 52-week low or the low in this cycle right now. Again, the price matters when it comes to an investor. It always matters as far as the outlook goes. The problem that we see, and this is a good and a bad scenario for stock investors, it's good because it's so liquid. You can always sell, you can always get your money back quickly. It's also bad because it's so liquid, because the prices can correct so violently and quickly that people become nervous and they start to think, well, maybe I should sell too. So these prices have come down. For example, Home Depot has dropped from $420 down to $272 as of earlier today. The yield back here, if you bought a share at $420, was 1.8% because you're still getting the same dividend amount, at least into the current year. Now, if we divide the current price and we divide $7.60 by the current price, we're actually making almost 3%, 2.8% on our new investment dollars. So that's a big jump in yield with the price going down. And so you're thinking about, well, that's an attractive yield when I compare that to what my bank's paying me. And you know, most of us are realizing that the bank paying you 0.1, 0.2, 0.5 even, kind of at the max level if you can shop it around. Whereas you can look at some of these companies that have a strong history of paying these dividends, and not only paying them consistently, but increasing these numbers on an annual basis. Normal company like this will increase their dividend anywhere from 5 to 10% per year, which just helps add to the yield that we're going to pick up. And you don't have to do anything for the yield. That's just a passive income scenario for you as an investor. It's getting exciting. We're really liking what we're seeing in the value space in these dividends for new money and investors that are deploying cash right now. This is a good way to pick up some great income and enhance your portfolio's return. What would happen with stock prices from here? We think these prices look very attractive for a 5-year investor. Even by the end of the year, I feel like most of these stock prices should have a higher finish. So look forward to what's coming down the pike. Policy changes, stability. We're going to finally work our way through how high interest rates are going to have to be going. And we're going to see companies making the adjustments that are necessary to keep shareholders going forward in the right space with the right profits. So I'm going to turn the time over to Shaun. Thanks for tuning in. Call us if you have any questions. I'd love to talk to you guys. I know this is a scary time, but we've been through this before.
Thanks, Billy. I'm going to take just a few minutes here, walk through some quick talking points. I want to talk about some portfolio adjustments that we've made. I want to talk about bear markets and their averages, and then kind of take a look at where we're going. So I'm going to start first with portfolio adjustments. We have, I would say, de-risked our portfolios, gotten a little bit more defensive. We've talked about we've trimmed back on our growth holdings. We've added more to value and dividend companies like Billy talked about, and we've added to our commodity sleeve. We've also raised just a little bit of cash. So I'd call us a little bit defensive here. Doesn't mean we're worried or anything, but we're trying to position for the current market environment that we're in. Speaking of that, let's talk about bear markets. So you're going to hear that term. We're in a bear market right now. What that means is we've dropped from the previous highs, we've dropped 20%. That puts you in a bear market. How long do they last? Well, usually bear markets last about 11 months. If you look back since about 1927, bear markets, when they happen, they last for about 11 months, and the decline is right around 32%. So we're about there. So that kind of makes me excited, like, hey, this is finally almost over according to the averages. On the flip side of that, what's a bull market? Well, a bull market is when you go from the previous lows and you go up by 20%. And those are more fun to experience. They last usually about 4 years, just a little bit over 4 years. And you usually see a cumulative return of about 155%. So that's where I think we're headed. I think we're coming out of a bear market into a bull market. But it always feels like bear markets they last longer, they're more scary, they're worse than they actually seem they are. So we're telling everybody right now, stay the course. We feel like we're positioned well. This is the opportunity where if you are adding to like a 401k or you have underutilized cash sitting in a bank, this might be the time where you want to think about adding to your portfolios where you can. So where are we going? Like I just said, I feel like we're going to start recovering here. There's a few things that need to happen though. I really think we need to get a handle on this inflationary environment. It's kind of gotten out of hand. I mean, it's really ran away from the Federal Reserve. They're trying to increase interest rates because their target inflation is around 2%. So you're starting to see these hikes, and that's trailing out into mortgage loans, into car loans, and everything else, and that's going to correct prices with everything. The stock market prices, they always correct first because they're so liquid, and then everything else will follow that. So if we go into a recession, what we're telling people is, hey, a recession does not mean a total collapse of everything. I think this market has seen this coming, and it's really priced this in. So I don't think, if we announce, hey, we're in a recession, it's going to be a major shock to anything. I think that's already priced in, and the market will tend to move forward through that. The gas prices, I think that's a huge problem for us right now, and I think there's a lot of overregulation in that industry, and there's a lot of shutdown of different drilling leases. And so now we're, instead of being an exporter of oil, we're an importer of oil, and we're trying, to lower our costs by doing that, and it just doesn't work that way. So we have less supply, more demand, and that's why our costs at the pump are so high right now, and that just trickles down to everything else, with food, with labor, with materials, with vehicles. So that's why we're seeing these prices, and we're going to need to see some change, I think, in our government policies to do that. And I think it's going to come with the midterms. I think you're going to see a wave of Republicans pick up new seats, and they'll typically deregulate that type of industry, and then hopefully we can see some lower gas prices. And I'm not trying to be political, I'm just trying to state the facts and the way that we see it right now. So if you want to argue with me, call me on the phone, I'm happy to. That would be kind of a fun conversation. But yeah, there's things to be excited about. I really feel like we're starting to bottom out here. Markets will turn around. So don't get worried. There's never good news on the news. There's always bad news on the news because they want us glued to it at all times. But give us a call if you have questions. We're happy to discuss those changes that I talked about with you and how it affects your portfolio, and make sure you're on track with your financial plan. So please call us. We're here all the time. Cade's going to take a couple minutes now. He's on growing with his career path, so he's got exciting news. Happy to have him on board, and I'm going to turn it over to Cade now. Thank you.
Thanks, guys. Just wanted to introduce myself to those of you who don't know me yet. My name's Peterson. I've been working here for a little over 2 years now. I recently graduated college. I got my bachelor's degree in finance at Weber State. And early last week, I passed my securities exam, so I can now give investment-related advice. I've been learning from Billy and Shaun for the last couple years now, so I'm really excited to be a financial advisor alongside them. A little bit about what I've been doing. I've been mostly building financial plans, and I've been meeting with clients in reviews and going over their accounts and their financial plan. And I think that's really important, especially in these volatile times that we're having, is that knowing you still have a financial plan, and regardless of what the market is doing, you can lean on that plan to know that you're going to be okay in these times. So wanted to let you guys know about that. If you ever have any specific questions or you're curious about setting up a financial plan for yourself, just give me a call. I'd be happy to talk you through things and build a plan for you personally. So thank you for joining us today. I really appreciate it. I hope you guys have a great day.